So what makes a hedge fund or a fund successful compared to retail? So like obviously we've gone through the GameStop saga back in 2021, where there was a lot of like mentioning about all these large funds that obviously it was David against Goliath. And basically, can you like share more information about that and and the myths and differences between big funds and retail, and why is this important for retail investors?
Sure. I think there are a few actually misconceptions that are interesting to mention. So almost every single day I see reactions when somebody from Bloomberg posts the performance of the biggest hedge funds, and then of course the most frequently commented type of reactions are around, oh, why should one be paying so many fees or so much fees to this advanced hedge fund when they are underperforming the S&P 500, right? So that's the one thing that every single day people are really reacting when it comes to really hedge fund performance. But I think that's a misconception because people neglect the fact that typically hedge funds, they have different mandates compared to the typical retail products that are out there, right? And then typical retail products are particularly passive funds or passive indexes, right? Sorry, passive ETF products like ETFs and funds that are really passively following an underlying index, right? Like the S&P 500. Though, and that's a very different type of product and goal than those that hedge funds are trying to achieve. Typically hedge funds, as one might infer from the name, they're trying to offer a prop value around being a hedge. I think that's why it's called hedge funds. One should think about really who are the clients of hedge funds, right? So typical clients are not coming from retail, they're coming from endowments, institutional, corporate investors, qualified investors, so not really retail. And then when you look at really those clients, they typically already have a large portfolio with billions, many billions. And then when they allocate capital with a hedge fund, again, they're not trying to, their ultimate goal typically is not solely beating the S&P 500, because remember, they might already have a big allocation on the S&P 500 from somewhere else in their portfolio. So when they add hedge fund capital, or they give capital to a hedge fund to manage, they're really looking for diversification. So can these hedge fund deliver returns uncorrelated with the market? So that's at a very general level the goal of a hedge fund. So one should not be looking at hedge fund performance from a return alone basis. Should be on a risk-adjusted return basis, right? So what the reports fail to address is really what is really the performance attribution against market risk factors, and to what extent the return delivered by a hedge fund was really decorrelated from the marketplace. One can actually mathematically quantify and prove the following statement that I'm going to say right now. Actually, a strategy that delivers negative return could be beneficial to you if that strategy is perfectly decorrelated or uncorrelated with your own performance. So really, it's about being orthogonal. That's the value prop of hedge funds, right? So that's a big difference with retail investing. It's important to really define this in order to answer your question in terms of really how to be successful. Now it's easy to answer the question. Well, the answer is you deliver orthogonal alpha, right? Yeah. So you outperform your benchmark, but in an orthogonal fashion. So that's what you are really committed to deliver as a hedge fund business, of course, at a very high level, right? Because there are all kinds of mandates and products that hedge funds offer, and how to be successful in actually achieving this. I think it's really about, of course, number one, the people. Number two, having very strong risk models, so you really can, quantify what orthogonal mean, and then really what is your risk budget for your alpha, and then having alpha factories, right? So if you can have highly talented people that can build risk models, allocate those risk budgets to alpha factories that are really delivering or that then enabling orthogonal alpha, you can be successful. And of course, data is helping you on both fronts. It's helping you really quantify risk accurately. It's helping you build alpha factories.
Okay, makes sense.